Good afternoon. Good afternoon. It's the 6th of May, and welcome to another edition of Monday Market Picks. My name is Tilan Wickramasinghe. I'm the head of research for Singapore. So thank you so much for joining us today. We've got a lot to cover today. Policy support and foreign buying is breathing some life back into China as well as Hong Kong, while the US markets are shrugging off the rates on hold by the FOMC and keep re-rating. So we've got Hak Bin on the show today, and he's going to be talking to us about how to make sense of the latest FOMC decision, as well as the weak manufacturing numbers coming out of Singapore. We also had DBS coming out of the blockbuster first quarter. So can it last? I'm going to talk you through that. And then we've got a brand new Opportunity Plus stock from Jeremy Yap in Malaysia. He's going to be talking about why this stock is going to break out very, very soon. And it's already kind of breaking out. So hang out till the end of this show to find out. And then finally, we've got Nick, the chart guy, with some very interesting charts for this week as well. Download our latest newsletter. You can do that from the QR code in the screen right now or through your app. So please do that, because there's a lot of information there that will help you throughout the week. Let's start with the market moves. A lot of markets last week were in the green. We had Dow Jones up 1.2%, S&P up 1.3%. Really, the NASDAQ rounding off up about 2%, largely from the very, very strong AI-driven numbers from some of the Magnificent Seven. We also saw the Hang Seng Index up about 1.5%, partly from Chinese policy support, starting to crystallize a little bit and giving a little bit more direction. We did also see the ASEAN markets move as well. KLCI up about 0.6 and the Thai market up about 0.5. So a lot of positive momentum going into this week. So let's start with Hak Bin. Hak Bin, welcome to the show.
Hi, Dylan.
Look, I mean, FOMC kind of held rates steady last week. I think that was fairly well expected, but they've also kind of said that rates will be higher for longer. They've also started to cut quantitative easing as well. They're doing more quantitative tightening. They've also started to do quantitative tightening less than what they said they were going to do. So what does all this mean, and what is the implication for interest rates as well as inflation going forward?
Yeah, so that's right, Dylan. I think the Federal Reserve left the funds rate unchanged. That's for the sixth time in last week's meeting. That's widely expected. And both the FOMC as well as the press conference signal that interest rates will be higher for longer. I think the other important point is that Fed Chair Powell also said at the press conference that it's unlikely that the next move is a rate hike. So this threw some cold water in recent market news, which was more chance of a hike given sticky core inflation. And I think his comments put a rally in the markets. With the US jobs figure that came out on Friday that showed the US economy only adding about 175,000 jobs in April. That's well below expectations, and that's the smallest increase in 6 months. I think that's helping markets as well. On the pace of the quantitative tightening or QT, the Fed announced that they'll begin to taper the QT in June, slowing the monthly balance sheet reduction to just 60 billion from the current 95 billion. Just to recap, the Fed began QT in June 2022 at the rate of 47.5 billion, which was then doubled to 95 billion a month from September 2022. And now this is going down to 60 billion. What it means is that the easing will reduce the pressure on longer-term bond yields. And I think given the latest signals on from this FOMC meeting, we're looking for the Fed to cut by 50 basis points only this year. Still looking for 100 bips cut next year. And I think the cuts will probably occur pretty late, either starting in the September or late or October meeting.
Right. So what a difference a quarter makes. I mean, we started this year expecting 5+ cuts, and now we are down to 2. So that's something to watch out for. Now, Hak Bin, I want to switch gears and actually come closer to home in Singapore. March manufacturing plunged for the most in 7 months. There was a glimmer of hope at the beginning of this year in terms of manufacturing recovery and so on. What has changed, and is this systemic?
Yeah, I think that was a bit of a surprise, because we were looking at better numbers. I think most of the street was, and PMI numbers for Singapore has actually been pretty decent and is in expansion terrain. So yeah, manufacturing plunged by 9%. Electronics saw its weakest performance since August 2023, and semiconductors were 14%. There was some positive growth numbers in the infocoms and consumer electronics, which actually rose by over 18%. So I guess what's happening here? We think that the electronics recovery is lagging behind some of the other Asian countries because you saw the equivalent, March numbers of Korea or Taiwan or Vietnam. They're pretty decent. So I think Singapore's tech production structure may not be as leveraged to the ongoing boom in AI, in advanced chips for artificial intelligence as compared to Taiwan or Korea. Singapore chip semiconductor ecosystem is built around more mature nodes, so more exposed to the automotive and industrial chips, which is showing a bit of signs of somewhat of a slowdown. I guess looking at TSMC, they highlighted in the first Q earnings call that demand for auto chips may actually fall this year amid tapering EV sales growth. And I think the other thing that's probably having an impact is also China's self-sufficiency drive, which is urging its EV makers to buy local chips instead of foreign-made chips in its efforts to galvanize its own chip sector. We're seeing some of Thailand's numbers as well that China's industrial push and excess capacity may be posing some challenge for ASEAN's export recovery. But still, all in all, we think that the manufacturing export numbers will show up in the coming quarters. I think the MES, guidance in the latest briefing as well was that they think that the electronics upturn will broaden. So I think it's going to go beyond AI, which should benefit Singapore. So we're still expecting better numbers in the coming quarters. For growth, we're looking at 2.4% this year. That's still up from the something like 1% last year, and that's at the higher end of the government's 1 to 3% range. But it's just the first quarter growth will probably be revised quite a bit lower to 2.2%. MTI flash estimate was 2.7%. And the downgrade is simply because of this surprise and shocking manufacturing plunge in March. Bear in mind that services did very well, and it's probably it's rebounding quite nicely, and that's surprising upside. So tourism, regional trade volumes, some of the financial activities are picking up, which is supporting Singapore's growth.
Right. So we may see some downside surprises to GDP for the first quarter, but then a pickup as we go through to the rest of the year. So hopefully brighter days ahead, and more services also contributing to Singapore's growth. Thank you, Hak Bin, for joining us.
Thanks.
Now, the higher for longer narrative that the Fed is pushing is obviously quite positive for the Singapore banks. We've had the banks rallying, especially the last month, and it kind of capped off with DBS's results last week. The first quarter results were a record numbers. And we upgraded our target price for DBS to 38.87, and we are retaining our buy call on the stock. Now, why is that? You would have read on a lot of analysts around the streets have been saying that some of that beat came from trading income, and that is true, and that might be hard to keep pace with in subsequent quarters. But we also saw some structural changes in terms of where earnings are coming from. We saw a big improvement in wealth management. Remember, the whole of last year, wealth management has been in the doldrums, and we're starting to see that moving to positive territory. DBS has been getting massive amounts of new inflows for wealth management the whole of last year, and that pace is still continuing in the first quarter of this year as well. So as clients start to take money off fixed deposits and put them into more fee-generating activities, we should start to see wealth management picking up. Plus, interest income will remain higher given the overall policy rates. Management is also locking in yield by parking some of this excess liquidity that they have in mid-tenor instruments. So even as rates start to fall, these instruments will provide support to keep overall yields on the assets high. And if rates actually don't get cut, even the two cuts that have been talked about, then obviously we have an opportunity to actually upgrade DBS's earnings. Plus, we are also expecting loan growth to be a lot stronger this year, especially from the regional markets. So that will also be very supportive. Now, all of this will go towards supporting higher dividends for DBS. One of the key takeaways for me was the fact that management said that they already have excess capital. So they will be looking to reduce their capital throughout this year. So that increases the chances for special dividends, much like what we saw last year as well. So that's something to watch out for. And also, I see a question from Alex Ferber, who's asking, what do DBS results tell us about the other banks and which one has the most value at this moment? So I think that's a good question to ask at this stage, given that UOB is reporting on Wednesday and OCBC is reporting on Friday this week. We think the sort of trading income boost that DBS saw, a similar sort of opportunity lies with OCBC as well. They will have a double whammy from their trading income, also from the insurance book with Great Eastern as well. So that's something to watch out for. We also think that provision side for OCBC could be better. So that will probably release some, more upside in terms of earnings as well. And also remember, they've got a very strong private banking brand under Bank of Singapore. So that also might provide the same sort of tailwinds that DBS saw. So I think going into these results, and as we've discussed and published before, we think OCBC has a higher chance of surprising on Friday. Now, let's change gear, go from Singapore to Malaysia. We've got Jeremy Yap on the line as well. Jeremy, welcome to the show. Let's just wait.
Hi, Thilan.
Hi,
Hi,
Jeremy.
Thilan.
Hi,
Yeah,
good to see you. Let's see you, if you can switch on your video as well, Jeremy. Look, you've written a really interesting report on SAM Engineering and Equipment in Malaysia. This is Malaysia's first Opportunity Plus stock that has been released. Remember, audience, Opportunity Plus is Maybank's high conviction small and mid cap series. And so, Jeremy, want to talk to you about this. Before we discuss the report, can you tell us what SAM Engineering and Equipment actually do?
All right. In simple terms, SAM actually has two complementary business segments. And the first one will be aerospace, and the second one will be equipment. SAM's aerospace segment specializes in the precision machining of niche aerospace products that are used in a wide body, narrow body, and regional and business aircrafts, and mostly in the scopes of nacelles and engine cases. And for this segment, their end clients are the duopolies, Airbus and Boeing. SAM's equipment segment provides equipment engineering solutions like precision machining, metal sheet fabrication, surface treatment to the semiconductor and data storage industry. In layman terms, they either do components, parts of equipments, or entire equipments for their three main customers, which we will annotate throughout the call as customers X, Y, and Z. Okay, customer X and Y are high quality front-end SPEs, semiconductor production equipments, directly servicing foundries and fabs globally, such as TSMC, Samsung Electronics, Intel, etc. And meanwhile, customer Z is a renowned globally back-end ATE player, and its top-paying customers are Texas Instruments and TSMC as well. SAM is a leader in the Malaysian tech industry with exposure to superb high-quality global semiconductor names and the duopoly of Airbus and Boeing.
Got it. So in two very, very good and obviously right place, sort of right time sort of industries for SAM. And you're rating the stock a buy. Can you give us the main points?
Okay. Personally, part of the criteria before I choose to initiate a conviction buy on any stock, basically on a specific stock, needs to have the requirements of, like, firstly, strong management, right? And secondly, where I'm able to envision the back-to-back earnings growth at least for the next 2 to 3 years. And I'm seeing that in SAM. And also, I believe that SAM is a secular growth stock. I think for very good and solid companies like SAM, why is it a buy now? It's extremely unwise to time the market in a sense. Nobody can tell when is the perfect time to position into companies like this, right? It's backed by Temasek, which is Singapore's sovereign wealth fund, has strong front-end semiconductor exposure to customer X and Y, and also supplies to Airbus and Boeing as end clients.
Right. So strong management, some great clients, also backed by Temasek as well. That's a plus. Now, and you're right. I mean, in terms of timing the stock, I mean, the stock's up about 40% in the past 3 months, and it's already up another 14+% today. So, you know, how should we look at catalysts going forward? What are the other things that can push this stock higher?
Okay. Firstly, end of this month, it will be earnings delivery. And secondly, I think that investors are always trying to time the bottom on when like the worst is over in regards to all these two sectors basically. And so the main catalyst will be earnings, and also when guidance on global news flows of when the WFE, which wafer fabrication equipment upcycle kicks in, SAM will be re-rated significantly. And also with the runway of earnings growth over the next 2 to 3 years, SAM is pretty much my conviction call. I'm not promoting this name as a one-trick pony or one-hit wonder. It's a thesis and a gradual upward re-rating over the next couple of years. Emergence of a new front-end customer would also be a possible re-rating catalyst for the stock.
Fantastic. Thanks, Jeremy. But I have to ask you, what can go wrong?
Okay, in every investment thesis, there definitely are risks. And the first risk that I would like to highlight would be another global pandemic, which would affect the entire supply chain in the aviation industry, which would affect the supply chain of Boeing and Airbus. And the second one would be a delay in the WF front-end CapEx cycle spending due to global inventory adjustments, longer than expected global inventory adjustments. And the third would be a loss of any key customers. XYZ would be a derating catalyst.
Got it. Okay, so there you have it. So please, do read Jeremy's report on SAM that's available on our newsletter today, and as well as a lot of the other stock picks as well. Thanks, Jeremy, for joining us. Now, I want to also talk about, when we're talking about AI and the semicon space, I do want to talk about another opportunity plus stock, which is CSE. That's one of Jarik's high conviction calls. We've got a note on that on our newsletter as well. It's won some solid orders in the first quarter, and first quarter generally for CSE is one of their weakest quarters. So we think the rest of the year is looking really good at this stage. And we also think that the AI boom will be a big boost to this stock. As more and more data centers come online in the US, they will need CSE's power management systems to keep these data centers humming quite nicely. Remember, data centers are extremely power hungry, so you do need very strong power management systems for these data centers. Plus, I think while you wait, you get a company that offers 6.5% dividend yield, which is pretty good at this stage, plus more than 20% sort of earnings growth coming through annually for the next 3 years as well. So do look at Jarik's latest note on CSE. Now, it's time for Nick, the chart guy. Nick's got some really great technical charts this week. So Nick, what have you got for us?
All right, thank you for having me today, Dylan. This is actually the follow-up with what we highlighted in a month before, which is our regional trends almanac. We highlighted the index for the first Monday of the month. So as per last month, we actually believe that there's a room for further upside, but it could actually consolidate within the tight range. So those range, the consolidation that began back in December has particularly ended following a breakout move last week. So last week again also has validated the breakout move, and for the first time, I think the index has been traded above the critical resistance, which is say at a 3260. So those level now turning into a short-term support, and we think the STI index has room for further upside. If you look the trend structure for the STI index, I think you have to look on the top panel there, whereas I highlighted the RSI. RSI is the indicator where we measure the trend they measure the momentum, and if you look the trend of momentum is actually start picking up. The what we call that the consolidation within those kind of rectangle has ended. A breakout move in RSI indicate a stronger momentum, and those momentum has a decent what we call that could actually fuel further upside in the index. So we think the index has decent chance to trade higher as we put the net resistance target at 3370 and 3440 in short to medium term for the STI index.
Great. Thank you for that. Next one.
All right, so this is where I have what we call it. I got it slightly wrong because last month I expected the index S-REIT index to trade much higher, but the gain was pretty much kept within the immediate resistance, which set within, if you look on the screen, will be at the green line, which is sit at 13 SMA line. Now, despite the setback that occur afterward, the downside was pretty much kept right within our support, which is sit within at 960 and 1000 point. Now, what happened is instead of the double bottom, now the index is actually forming a triple bottom, and there's another interesting development. Whereas the recent decline was not followed by a strong decline move in RSI, meaning that it's actually forming a bullish divergence, which means RSI is forming a higher low structure, but the index is forming pretty much almost similar structure. So in that sense, the recent decline was not have something that we call a stronger selling intensity. So because of that, I do think there's more room for a technical rebound, at least in near term. So a rebound could lift the index back to the resistance level, which is actually sit at 1042 and 1090, while the current support is actually at 960 and the major low at 920. So I think those two charts are looking quite decent, at least for the near term, and we're expecting a short-term recovery for now.
Got it. Thanks, Nick. So short-term recoveries for the IEDGE REITs index as well as the STI index as well. So that's something to watch out for. Nick, thanks so much for joining us.
Thank you, Thilan.
Okay, so with that, let's have a look at upcoming events. We've got lots of results coming through in Singapore. We've got UOB, as I said, on the 8th of May. We've got AIMS APAC REIT coming out on the 7th. Sing Post, which has had a lot of attention recently, coming out on the 10th of May, as well as SIA Engineering out on the 10th of May as well. You get much more details on all these events in our newsletter. And also, let's look at some of the key events that are coming up. We've got the Paragon REIT event, which is on the 8th of May. As Nick said, you know, the REIT index might see some technical rebound. You might want to join this call to get some clarity on how management is thinking in terms of the overall REIT environment in Singapore. So do join us for that, and you can do that with the link that is there. We also got a results review from SI Engineering's management as well, which is on the 14th of May. And also a discussion on current market dynamics in TV and connected TV advertising from our partners, Wedbush in the US as well. So you can speak to your salesperson if you'd like to join us. With that, we are out of time for this week. Thank you so much for joining us again, and see you next Monday. And have a profitable trading week.